Okay, good afternoon, everybody. So we're on the home run now. Just 45 minutes or so talking about ESG in relation to captives before Roy will close the show. Before I introduce the speakers, maybe we just think about what's been said already about ESG today. In fact, many of our speakers have already spoken, have referenced ESG. Datuk Iskander referenced the fact that captives have the opportunity to embrace sustainability and achieve fresh relevance and allow the parent company to reduce their total cost of risk. DG Nick referenced the threats of climate change. Rob Curtis, first of all, talked about the increased supervisory expectation for good captive governance, and then talked about how AM Best integrate ESG factors into their rating models. Then Doreen from Labuan FSA remarked on how ESG is referenced in their latest 5-year roadmap, although the detail of that is yet to be defined. And then Lawrence talked about how he has a tangible project at the moment where a industry group is looking at how they can potentially finance their environmental exposures that may become uninsurable through funding in a captive vehicle. So lots of issues that have been touched on already, which we can start to unpack. And first of all, perhaps I could ask my panelists to just briefly introduce themselves and maybe just mention how captives touch on their work. First of all, Julie.
Hello. Okay, thanks everyone, and good to see that I expected half the crowd to remain, but thank you for staying behind. My name is Julie Ng, and I'm from RAM Rating Services. We are a domestic rating agency based in KL, but we are not as old as MBES, but we are 30 years old this year. And I've been with the company for about 27, 28 years, doing various things. Currently, I look after the non-rating business, which covers data analytics, research, economic research, and also new product development, such as ESG and all the other new things that we're doing. So how does captive impact what I do? Well, I have delved into insurance ratings as well. We do offer insurance ratings to onshore business, as well as we've developed a new service for Labuan, for underwriting companies as well as service providers. So that is, I'm not sure whether you heard of it, but it's LICA, and also under RAM. So we do provide to whoever is interested in getting rated as well. Besides that, besides getting from MBES, so we are a complementary provider to the jurisdiction. Yeah.
Thank you. Thanks, Julie. Nicholas.
Hi, I'm Nicholas. I'm the founder and actuary of Nicholas Actuarial Solutions. So we actually provide various actuarial services to captives, from feasibility studies to actuarial valuation, IFRS 17, as well as various risk management and other back-end work. So I first got to learn about captive when I was working in Bermuda in my previous role. So when I came back to Malaysia, I'm actually very happy to see that there's a thriving captive community here in Labuan, and always very happy to play a part in this community.
Thanks, Nicholas. James.
Thank you, and good afternoon, everyone. James Wong here. Speaking of Bermuda, I've been in the risk and insurance industry for 17 years, and with the first couple of years working in captives in Bermuda, so I might have been there a bit before you were. Since then, I've had the opportunity to work in Australia, Hong Kong, and now Singapore. I've been with WTW for the last 5.5 years, looking after our strategic risk consulting practice, which specializes in risk modeling, risk advisory. At first, I think as a business, we were looking at large clients, which many of them are captive owners, on more traditionally insurable risk. And now since then, we have been branching out, and actually a lot of our more recent demand are on climate-related risk and other complex and emerging risk. So great to see everybody here.
Great, thanks all of you. So ESG, we've been talking about it all day, but maybe we just need to unpack it a little bit, what it means. I think probably everybody roughly knows what we're talking about. and it's a frame and a concept that sort of emerged during my career. I think back to the late 90s, corporate social responsibility was the thing, then it became sustainability, and now it's ESG. But, you know, James, if I can ask you maybe to give us a bit of a working definition of what ESG means in this context.
Wow, that's probably the hardest question you can ask anybody in a public forum, because everybody, in a way, do know a little bit about ESG. So it is asking sort of how long is a piece of string. Now, maybe to frame it in the context of our discussion, I think we can mention a few things. So ESG, as everybody here knows, is environment, social, and governance. And so rather than more academic definitions, and there are even there quite a few of what it is, I think maybe it's easier to look at it in a few different ways. So when it evolved from CSR to ESG, I think there's an implication that is much broader, and you're not doing something that just for the sake of doing it. It does have, if you're looking at it from a risk management point of view, it actually could be quite central to the long-term viability of your organization. And actually to look at some of these things in sort of on things that an organization can, I suppose, manage and control. You know, when we look at environment, we can look at emissions, consumption, waste management, and also, you know, closer to the risk and insurance world, if the resilience against physical climate risk that can happen in the long term. And under social, I think and social, it could be quite contentious, but looking at something that a bit more universally agreed upon, we can be looking at the way that we engage with our employees, all the way from the compensation, the benefits, the workplace health and safety, the well-being, and all the way out to, you know, training and development. And then from a governance point of view, then it's probably something that's quite near and dear to a lot of you here. I think just the fact of whether this is you're talking about insurance or captives, there's already a strong foundation of governance in there. So I think this is really more about sort of having assurance, having a good framework, and all of that good stuff that you, probably a lot of you have a lot of expertise on. So yeah. I think I'll take a pause there.
Great, thanks, James. And many of the people in this room, myself included, come from the sort of general insurance, reinsurance background. And a lot of the lens that we get on a day-to-day basis around ESG comes from the expectations of large international reinsurers, and particularly European ones, and their focus is often on the environmental aspects that you just addressed there, James. But Julie, when we think about ESG in Malaysia and perhaps Asia more generally, how has ESG evolved as a framework or a perspective here in Malaysia, first of all, perhaps?
Okay, I think governance has always been around for the longest time in Malaysia. So ever since I started I started as a rating analyst, we have always looked at governance when we rate companies. But in the last maybe 8 to 10 years, ESG has come to the fore because, well, after all, we're in Asia, and we have the world's 2 top carbon emitting nations here, China and India. So I think that has really kicked off the agenda for ESG. So now we see a lot more emphasis in ESG. In Malaysia itself, just to give you a perspective, I think the push comes from the government first. And for example, in Bursa itself, they have this FTSE for Good index, and now there are about 87 companies, public listed companies that are in that index. That index basically includes constituents or companies that have good ESG practices. So the index does vary a lot. I mean, sometimes they kick people out if you don't comply or you end up on the wrong side of the fence. But yeah, so we see that progressively started from about 24 when they started in 2014, and now we have 87. So we are seeing some good progress there. In terms of reporting as well, is mandatory for ESG reporting, or what they call sustainability reporting for all PLCs since 2016. Yeah. And recently, I read some surveys regarding the Malaysian financial sector. I think they've done quite well as well. surveyed all the banks, insurance companies and service providers, and 90% said that they have a sustainability strategy in place, or they have a department to already operationalize ESG. And of the about 24 banks, and both public and private banks, 70% of banks have commitment to either ban or gradually phase out the financing of coal-related activities. So that, I think, is within 8 to 10 years, that's significant progress.
Yeah.
And when we also deal a lot with fund managers and asset managers in the market, and they have all been coming to us fairly rapidly in the last 2-3 years. To ask us, how do we look at ESG, and can we help them, look at both the liability side of the books and the asset side of the book. Yep. So I think we are seeing a lot of interest in ESG, not so much from compliance as well. I mean, compliance and regulations is an important driver, but from awareness and from a lot of expectations from stakeholders, as you say. Yeah, so I think that is the push. Yeah.
Great, thanks, Julie. In the 2 earlier panels this afternoon, Lee's and Halim's, we started to hear about how risk that was identified as potentially being one that could be considered by the captive, how the parent and the captive team would go through the feasibility study process, the analysis process. Nicholas, this is very much in your world. When it comes to ESG risks, and we know we're talking about a very broad spectrum of risks here. What are some of the issues and challenges around quantification and that analysis piece about really making good quality data-driven decisions when considering captive utilization for this sort of exposure?
So I think one of the challenges is how to quantify this ESG risk, which is long-term in nature. But what we know is that ultimately, right, ESG leads to potential volatility, and basically the risk is that we do not meet our business objective because of ESG exposure. So it has been increasing that we have financial scenarios in our projections of various type of ESG scenarios. This can be from climate change, this can be from a lack of reinsurance capacity, and so on and so forth. And ultimately, we can see that if an insurer or a captive would like to take on more ESG related type risks, basically it would affect the amount of capital that they need to hold, because that they will be exposed to this risk if they do accept it. And at the same time, it's not so easy to actually transfer this risk out to the third party. So actually, management of ESG risk becomes more and more important. And with the increasing sophistication of the financial models, we are able to quantify and at least try to attempt to quantify what are the benefits long-term and short-term from actually having a better ESG strategy in place.
Thanks, Nicholas. So if I can ask the panel to now sort of switch their perspective a little and think about how the captive team, their advisors, interact with the parent. Obviously, a captive and its advisors should not be thinking of ESG in isolation. It's within the context of the overall parent group strategy. And James, maybe if I could ask you about how a typical captive owner would think about risk and opportunity related to ESG. And when I say risk, I mean the downside risk, the threat, rather than so the opportunity for loss. So that how would you think about that, James?
Yeah, and that's quite a bit to unpack there. And I think some of the reason that this topic can seem a bit daunting is that if you think about ESG, it's not just one singular risk or one singular thing that if you do well, that leads to some opportunities. You can actually break it down into smaller pieces, and then that in a way makes it a little bit more digestible. So you got some individual risk within E and S and G. Now, I think maybe taking one step back and thinking about, so a lot of the ESG is really that we really talk about commonly is to convey to your stakeholders, and that could be your investors, your lenders, your customers, your employees, that these things are being managed well, and that does lead into the longer-term viability and good reputation of that organization. So now, in a way, it isn't as difficult as one would imagine, because as a community, I think a lot of you have dealt with a lot of complex and emerging risk. So taking something a little bit more recently, so you have, let's say, cyber risk. And the idea is that while it took a little while to happen, but it was a matter of having yourself engage with the subject matter experts in your respective organization. And in that case, it would be your IT security, your information, your other stakeholders. Probably no different from ESG. So if you got some, if you got sustainability expertise, or if you've got corporate planning, you've got finance people, those would be actually give you another opportunity to engage with them, to really just understanding within the bigger umbrella of ESG, what are the more critical or high impact items that could impact your organization. And that could be quite company specific. So that's probably, I'll take a pause now, but I think these are the overall considerations that I suppose a captive owner would think about before diving deeply into the financing part of that.
Great, thanks, James. Julie, you mentioned in your opening remarks that you're now building in to your rating models ESG components as AM Best Star as well. Can you maybe just talk in a little bit more detail about how that works?
Okay. Yeah, we do incorporate a comprehensive ESG framework into our traditional credit rating now. So, in fact, we have been a signatory to, this is a mouthful, the UNPRI statement on ESG in credit rating since 2016. And that's also when we started our active drive into ESG to see how we can look at the data and structure it in a manner that we can incorporate and try to quantify that into the credit ratings. So what we have is a whole host of areas that we look at under E, S, and G. G is easy because we've already done it for the last 30 years. So E and S, we had to break it down into all the different pillars and the dimensions, following many of the standards that are out there. I mean, there are lots of standards, different international standards, and even standards issued by Bank Negara and SC as well. So we melt all that together and we establish a framework that has like more than 200-300 questions, which we will look at systematically when we assess the E and the S part plus the G part for any company. So then what we do is that we try to look at the impact and try to assess whether that impact, those risks under E or S or G will filter into any financial impact for the company. And if it does, then we will look at whether we need to adjust the rating. So for a bond issuer, if you have unmitigated risks, either in E, climate change, or if you're a manufacturer, or in S, for example, if you're a service company, you have serious breaches in, let's say, workplace safety, or compensation or whatever. We then looked at, does this impact your immediate or your near-term future viability in being able to repay your debt obligation. If it does, then we may adjust the rating downwards. So on the flip side, if you do have fantastic practices and all that, and it helps with your branding, your market position and all that, then we say that it is supportive of the rating. We may even, look at maybe upgrading the rating within a short span, yeah. So I think that's how it impacts the rating, because it does, we recognize that ESG risks ultimately will have impact on the financial viability and the sustainability of the business, and all that translates into the P&L and the balance sheet.
Yeah.
Yeah. So that's how we incorporate that. But not everybody is a bond issuer. So of course, then we realized that we have to offer other services. So we set up a sister company under what we call RAM Sustainability to provide advisory for other types of services needed under ESG compliance. So the sister company does climate bond certification and also provides sustainability ratings for climate for any issues that companies want to raise as a green bond, as a social bond, as a sustainable bond. So we do all that, and we also provide a risk framework to help investors look at what sectors they should be looking at and what they should be avoiding. So these are some of the new services which we have parked under RAM Sustainability to try to help companies manage their ESG risk.
Great, thanks Julie. So Nicholas, Julie's just talked about there how RAM uses objective tools to help understand the impact of ESG risk on a particular corporate. Earlier you talked about the type of tools that you would use at a captive level around risk analysis and modelling. How do you see the role of the captive team and their advisors in working with their corporate parent to help manage that interaction between the corporate parent's ESG strategy and risk appetite and what the captive itself and their team can deliver?
So I think normally the parent is the one that needs to set the tone on the ESG from the top. This has to be clear. And then what happens is that so most of the large corporations that have captive have some sort of ESG exposure. This is inevitable. Some of this exposure can be placed into the captive. Some are not. And when it's placed into the captive, I think there needs to be a strategy, as in we are not dumping the ESG risk into this captive because we have nowhere else to put it. There needs to be a plan in terms of the funding. How are we going to fund the captive so that when any of these downside risks are materialized, the captive remains sustainable. And at the same time, I think what is very important is that that there is a clear communication of and a strategy, right, of how to actually reduce the overall ESG exposure in the long term. I think the challenge is that is the timing, because in the long term, I think every corporation will have this goal in this ESG goal, and this is a clear long-term goal that everyone has. But how to get there and when we can get there is a challenge. So in this process, the captive can play a role in terms of helping to fund some and finance some of these risks, helping the parent to get access to reinsurance as well as alternative markets from time to time to actually mitigate some of this exposure and gradually reduce them over time.
Thanks, Nicholas. And I think a question that I've just seen pop up on the screen there sort of fits quite well with this, which is what you're talking about, which is a corporation may have maybe moving in its ESG goals towards a particular outcome over time, but the expectations of the insurance market may not be aligned with that, certainly in terms of timing. And the question from SY is how to mitigate the limited insurance and reinsurance capacity due to ESG other than having your own captive. Okay, so how to mitigate the limited insurance, reinsurance capacity due to ESG other than having your own captive. Now, James, I think this is a broker question because brokers are good at thinking on their feet nimbly.
It's been a while since I've done any broking, but I'll give that a go. I think we do have to acknowledge that, I think there's a few people that talk about this earlier, that that insurance itself is a very structured solution in that sense. In a way, it limits the flexibility of what it can do, even though by and large, 99% of the time is a very proven and efficient solution. And this is the area where the captives can really help the innovations or help sort of develop new risk transfer solutions for the broader markets, is that it does sit very nicely in that cross-section between risk management, funding, sort of risk management activities. You can also collect data or use that to actually do some R&D to see how the risk can be financed. But more specifically, I think acknowledging some of the limitations that we have in the commercial markets. For example, if we look at some of the climate-related risk. Now, generally speaking, you wouldn't be able to insure physical risk that happens 5, 10, 15 years from now, right? Or anticipate that Nat Cat would get worse and worse, and that I'm just going to go buy some Nat Cat capacity 5 years from now. It doesn't quite work like that for good reasons. But that doesn't actually prevent that if you have a captive, and especially one that's reasonably sizable and established and profitable, is to use some of that money to either directly fund the risk mitigation piece to make the assets more resilient, but also actually to put some money aside for maybe even a longer term program. Because a lot of the more, if anything, and hopefully not going down a bit of a tangent here, we do have come across a lot of more established captives globally, and there are some in this room, where the captive has been around for a long time. It had been successful, and they've got, in a way, some money that they don't know what to do with. And it was always a matter of, do we just put more risk on sort of more conventional insurable risk, or do we try to develop a product internally to actually satisfy a need that isn't quite sort of quite available commercially? So quite a few things to think about.
Yeah, and as you were talking there, James, I was thinking about the conversation we were having at lunchtime, and this is around the difficult to quantify or too big to apply rational amounts of capital to type risks, and let's talk about reputation. With all the ESG, the external stakeholder ESG expectations that are placed on corporates now, one of the things that can be impacted if in the event of a perceived failure to act around a certain ESG dimension, whether it's justified or not, can result in a significant reputational hit, which can be impact on the value of a business significantly, which will be too big to finance anyway. But where do you think, when you've got a risk like that, where can you break down the risk or the elements of the risk so that maybe the captive can assist in some way, James?
And that's going slightly ad lib today, because I think that was probably, for Nick and I, probably digested quite a lot of the takeaways from the earlier session.
Yeah.
So I do think that really depends on the size of your organization and depends on the size of the captive and sort of how out there do you want to be. Is that even if you're relatively conservative, because ESG isn't one item, right? Like that item itself is quite big, or as a group of risk is quite big. But if you start getting into the components, there will be some where you can probably find relevant data, even though it might not be exact like for like, but you could use it to sort of quantify that financial impact. And then you can think about in terms of risk transfer solutions or sort of self-insurance, and then sort of do it one step at a time. Climate was one example, but there would be others, maybe in the social part of it, maybe that has more to do with the employees that you can start with, and then just gradually go up from there.
Great. Thanks, James. So Roy's asked, of the three, ES and G, which alphabet would or potentially would require a captive to play a more urgent role? Julie, I don't know if you're comfortable having a go at this question. You look at a business perhaps more holistically than many people in this room, and maybe see where there is greater urgency around risk financing. Do you have any thoughts on that?
I think it varies from company to company. It depends on your business line, what the parent is doing. If you're in extractive industries, for example, then obviously E is very important. So for manufacturers and companies that use a lot of resources, land or sea or whatever, then E will become prominent. For services, like what we have seen so far, a lot of it would be S more than anything else. In fact, the E is not so critical for them. So we've seen, as the S agenda risen to the fore after COVID. So, suddenly they recognize that, or they realize that, workplace safety and occupational health and all that has become very important to take care of. Things like cybersecurity, digitalization, as we use a lot of technology during COVID. So all that comes to the fore. So I think if you're services, if you're parents in services, then yeah, the S becomes important. G is across the board for all kinds of companies, because I think that failure in governance has a big, not just a reputational impact, but a real financial impact on all types of companies. Doesn't matter. Yeah. So I think, does that satisfy you, Roy?
And I think we can maybe build on that actually. And I'm not going to take issue with an earlier panel. I don't want sort of an Anchorman style confrontation between conference panelists, but they touched on social inflation, and their reference point was really around, I thought, around general inflation, whereas I think there's actually, I think it's important to dig into this some more. Nicholas, when you think about social inflation in a risk financing context, what do you understand by that term?
So I think the challenge we have with social inflation is that the claims costs are increasing because of these social factors. So it can be because the court or the juries they have a certain bias to a certain party, or especially in the terms of ESG, what potentially can happen is that there's a reputational risk with companies that take on a lot of this ESG exposure, and in the public opinion, their reputation is not good, and they may be asked to, they may be made to bear the brunt of the claims. So, I think we can see, right, an increasing frequency of claims, and also an increasing severity of claims when there's a change of how the society is thinking towards who should actually bear the cost of these claims. So I think this is another aspect of ESG that actually is happening, but a lot of the times it's happening in the small and medium-sized claims, and is creeping up the claims cost without it being very, very obvious to everyone. Yeah,
and I see this as an area where you get quite a dynamic interaction between the conventional insurance and reinsurance market and a corporate, and what may have been traditionally insurable, but because of social inflation, the changing boundaries between who bears the financial consequences of the risk, this is where the corporates can be caught out. And I think back to early in my career, and I haven't spent a huge amount of my time dealing with captive risk necessarily, but a very challenging example which those that have worked in the UK, the US, or Europe might have seen, and this is the issue of abuse-related claims. And one of the large Christian churches, denominations had big issues around this, which they were financing the costs of in their captive, and this is going back to the early 90s. And that's the type of thing that maybe hasn't been seen so much in Asia, but will be increasingly an issue. And I think anybody that's involved in advising or insuring any social organization, university, school, has to be cognizant of that type of exposure, and a really difficult exposure, and different from the things that we might first come into this room thinking of, coal, etc. But those are very tangible issues. James?
And I was going to add one thing that even on the social inflation point, even maybe abuses are not as prevalent, but what we do see here in different parts of Asia is that, for example, medical malpractice, that also has a social element to it. As people do get more aware of their rights, and there are more knowledgeable lawyers in that industry to support them, social inflation will happen basically anywhere in the world, but it's a matter of when. But actually getting back to the earlier question, which I thought was interesting, that maybe I'll add one more point, is that it's not so much whether it's the E or the S that whether the captive can kick in, but one thing that people don't often think about is that when people buy insurance in a more conventional way, it's not to protect against a known cost, it's the volatility. So if I know that there's a certain regulation changing where I just got to spend $100 million on it, that's not so interesting for the captive. It's actually the volatility on, if I know for example, the cost of doing activity X could go up 5% or 50%, and there may be down the road, hopefully, a risk transfer trigger that hopefully cap the increase to a certain percent, and you buy off that volatility. Now that's a more interesting play, and that would be one that hopefully the captive can help incubate the risk for the commercial markets and become more insurable, so to speak.
Thanks. So in conclusion, Roy, of the three, E, S or G, which is the most urgent? Probably all three of them. So a question that I think actually was going to come up in one of the earlier panels, but was held back for this one. How would captives' acceptance to underwrite ESG risks affect its reinsurer's underwriting judgment in evaluating its facultative risks? How would captives' acceptance to underwrite ESG risks affect its reinsurer's underwriting judgment? Yeah, so I think that reminds me of one of the comments made by one of the panelists earlier around creating greater alignment. Makes it easier to sell the risk into the international reinsurance market. What do you think about that, Nicholas?
I think this is very important that the captive need to have an understanding of the reinsurance market before actually they accept to underwrite the ESG risk, because in a way the captive need to be able to have some independence in the underwriting, and it would be a challenge if the parent would be able to force the captive to accept anything and everything that they have, because then this risk will be stuck with the captive and unable to place outwards. Actually, moving a bit longer term is that there's also a challenge, because when there's a captive arrangement, the parent would always expect that the captive would take the same risk every year. But actually, what happens is that some of these ESG risks don't materialize immediately. So whereas the insurance and reinsurance market, typically on the general insurance side, we're always talking about 1 year cover. So the parent will expect the captive to be able to take the cover for long term, but then whereas the insurance and the reinsurance market, the appetite for this ESG risk is reducing quite significantly, quite quickly over time. So there will be some challenge where the captive will no longer be able to accept all these ESG risks as much as in the past, and so certainly the reinsurers place a high significance, right, in evaluating this type of risk, and the captive also need to be able to establish that there is this high level of risk identification, because not every ESG risk is very easily identified, and the risk of the parent indeed change over time. So it is something that's quite dynamic and hard to have a long-term certainty on this.
Great, thanks, Nick. James, to come back to the issue of how captives are filling in the gaps of risk financing where the traditional market's maybe not playing such a, maybe changing its appetite or not playing the same role. So how do you think captives are currently responding to the gap between what the traditional insurance market can provide and the ESG risks faced by captives?
Now, there are just so many different opportunities that probably, without sounding critical, I think captive owners generally are conservative as a group, as a demographic. So, and I think when we get into this space, I think there are just so many different ways of the captive supporting or filling the gaps on those risks. So I think we touched on sort of climate-related risk earlier, but we also could potentially looking at there will be other things that come out of it. For example, you know, we talk about people talking about greenwashing or litigations around reporting. That could be something that will be more prevalent, and in a way, if certain things become more prevalent and you think that your risk profile is better than the rest, that may be attractive for risk retention. There will be other things, probably maybe more on the employee attraction or retention, or talent attention and retention view. The captive could very much be something that you can use to differentiate yourself from other employers. So, if you start going down each categories, you could probably easily find 5 or 10 things that, as a concept, is worth testing, and then ultimately you can draw a roadmap and say what's something that you can do immediately and what's something that you could park it for the longer term.
Great. Julie, James just used a term there which I vaguely understand, and maybe others in the room are also a bit unclear about it, but greenwashing. Are you able to explain that a little bit more? And have there been examples, and examples that you can think of, where greenwashing and risk financing have touched upon each other?
You're asking me to explain what greenwashing is?
Yeah, I know. I hadn't prepared you for that question.
Okay, greenwashing is when you say you will do something, but behind you don't really do it, or you say that you have met some targets, but actually you haven't. Yeah, so I think it is basically telling a lie, so
okay,
and not delivering what you promised to or set out to do.
So it's misleading external stakeholders under the guise of a corporately responsible set of policies. And was there a recent KLM related?
Yeah, there was a KLM airline which said that they had certain sustainability practices and all that, when activists went to look further into it, and it's all greenwashing.
Yeah.
And there are lots of examples as well, because I think the science of ESG measurement is still in its nascent days, and it's very hard for us to even quantify. So we are still struggling when we are developing the framework. It is a struggle to get the data, and because the data is all over the place. So when companies come and tell us that they are, setting up all these targets, how do we measure it, and how then do we certify that they have met all these targets? It is really hard, and nobody tells you what the threshold is, because each industry is different. So I think it's very easy for people to, greenwash the claims, and then it is up to the verifier to go and check, and where do you get the data to check that against? So I think the industry now is, in Malaysia at least, is actively trying to set up all these databases to consolidate all this evidence, of what people are doing and how do you measure it.
Yeah.
And also in terms of the data sources, there are lots of companies now that are doing platforms for us to look for data. So within a company, if you're searching for data, you can go to a lot of platforms, and you don't have to Google until kingdom come and look for all that. Currently, we also face that challenge. We also have to, when we search for example, governance risks, controversies regarding certain companies, some of them are very opaque, including some in Labuan as well. We can't find information. So then we have to look everywhere. So I think there are now a lot of companies are offering AI, web crawling algorithms and all that, which enables you to look for information very fast. And that's when we can verify and reduce the risk of greenwashing claims.
And does that then fit in with some of the challenges that corporates face, because there aren't consistent global standards around ESG? You seem to be saying that in that context, then proactive action by corporate in terms of accessing data sources so that they can validate their approach to external stakeholders is the way to go. Is that fair?
Yeah, I think everybody is looking for sources in which to help themselves, both the companies themselves and the people on the other side, the verifiers and the investors. So everybody is doing their own bit to try to get to the bottom of it, to try to measure and get a understanding, behind the ESG risk, and maybe not try to understand or not try to fully quantify it, but at least to understand where the risks are and what they should be looking out for and what they should be taking into account. Yeah. So I think that's where the industry is right now. Yeah. So we have a lot of. I think regulators are also helping in that sense. So they have put up a lot of joint committees, and within all those joint committees with Bank Negara, SC, Bursa, we are all talking about setting up platforms and dealing with third-party platform providers, data companies, and all that to try to get that ecosystem into place. Yeah.
Thanks, Julie. As we've already seen during the course of the day and in this discussion already, ESG risks are so multidimensional. But I think if you asked everybody as they're coming into the conference today, what is the most important ESG risk facing this community at the moment, it would be probably the issue of shortage of capacity for thermal coal risks. I mean, I think probably, you know, most people here today will be aware of that, if not facing the challenges on behalf of themselves, their clients, as an insurer and reinsurer. We face the challenge of keeping our reinsurers and our investors on board around this type of issue. Nicholas, you know, when you see this misalignment between the real needs, particularly in this region, for the continuing use of thermal coal, even without the challenges created by the war in the Ukraine. When you look at potential shortages of capacity, whether it is for a physical asset or for the D&O exposure, and you think about a captive potentially providing some sort of solution, what are the issues that you think are important, and what worries you about that?
Okay, thanks. So I think in terms of coal risk and for captive, actually is similar to all other risks that the captive can manage. I mean, go back to why do we have a captive, to get better access, to have a stability in cost, cost reduction, etc. So I think in a way, a captive can actually play a role in all these aspects to a certain extent. I mean, of course, while we are in a conference to promote captive, setting up a captive itself does not actually helps you eliminate all the problem with associated with coal risk. But at the same time, I think it's also it enables the access, right, better access to more capacity, more markets than only the domestic ones, and a large part of the domestic market in Malaysia and Singapore are actually dominated by the foreign players, especially European insurers who actually have a very low appetite of this coal risk. So with the captive, actually there's a lot more access, and there's also possibility of self-retention, not necessarily the entire risk, but at least part of it, like what we hear earlier about a sweet spot, so that it actually makes it easier to place the risk outwards. And I think the other thing is the other problem that we face in this region is that if there is a coal plant, it's very obvious that this is a ESG risk right in front of you. But there are actually a lot of challenges in identifying various ESG risks. For example, even flood which is something that is easily identifiable. During the previous flood, clearly it has been under-identified and under-quantified. So these are also issues that the captive can play a part. And of course, the liability type of risk related to ESG is really even more abstract and hard to actually look at. So I think captive actually really can help in terms of better overall risk management in various aspects, in terms of access, in terms of reducing the cost, providing funding, reducing volatility and such.
And just to add a very quick point on that is that if we think about the useful life or the remaining life of a lot of these fossil fuel assets, is that they do actually match up with the timeline of the lifetime of the captive as well, because even if you run into some challenges, you almost have to foresee that challenge would get more daunting year on year. So by actually acting on it sooner than later, you may have something that, you know, even if you're not in dire need of capacity today, because you may be relatively small, but perhaps in 5-10 years, it will become essential. So it's not doing that once you get into that situation, it's doing it, acting on it sooner than later.
And in fact, I think we've already just been giving a bit of an answer to a question here, which is please share any actual involvement of captive providing capital or retention for their parents' ESG risk. Is it a separate policy or extension of existing policy? Well, we're talking about filling in gaps for coal risks.
Yeah, I mean, it doesn't necessarily has to be like a separate policy or an extension. I mean, whatever the captive takes in and the captive does not place out generally is retained in the captive. So when sometimes there will be a gap between what the reinsurance market is willing to take compared to what the captive has taken in, and this is the risk that we remain in the captive, and we have to assess by ensuring that we have sufficient capital in terms of assets in the captive to actually take care of this risk in case the claims actually materialize.
Do you agree if we say that the captive is still depending on the parent? If the parent is involved with ESG, then there will be a push factor. And I take from that question, this is the obligation to try and finance ESG risk within the captive. And we're obviously in quite delicate territory here because clearly there may be that expectation that, you know, you're the captive, you've got a capital surplus that you've accumulated, surely we can use this. That we're back into governance here, Julia. Maybe this is your bailiwick. What challenges can you see for the interaction between a parent, corporate, and the management of the captive around the perception or the real obligation to try and bear this type of risk, you know, and how does that put the captive more fundamentally at risk, and how would you expect that to be managed, that tension?
I'm not quite sure I understand the question. But,
well, so it's more, I think we can clearly see that there could be a push factor for a captive to accept one of the ESG risks faced by the parent. And you looking externally in at that dynamic, how would you expect them to try and manage that?
Okay. I think, I mean, of course, if you want the captive to take on the ESG risk, then ultimately you have to align your strategy, the ESG strategy, to that of the parent and get the objectives clear, right? So I think, there is a natural push for parents to push out the ESG risk to the captives, but it doesn't necessarily have to be so, I think. Yeah, I mean, the captive can serve a lot of other roles as well, you know, as an incubator for ESG initiatives of betterment initiatives, for example. Those are positive, you know, how they can make a positive impact by the parent that can be farmed out to the captive. So it doesn't necessarily, you have to use the captive to sort of squirrel away your ESG risk. Yeah. But having said, I think when I looked at Labuan captives, the majority portion of the business is under general liabilities, which is, I suppose, is like your D&O and all other types of risks, right? Your liability risk and all that. So I think it is important because of that big chunk of the business being concentrated in general liability. ESG risk ultimately will drive, you know, the future liability claims, and I think that's an important consideration. So I think whether you like it or not, whether you're pushing from the parent to the captive, I think naturally it will go to that because all your general liabilities will probably evolve from ESG sources, ESG risks, ultimately. Yeah, whether it's from climate change or from social factors, or you know, I think it will stem from that. And so if you're covering general liability insurance for either for your parent or for someone else, I think naturally you have to look at ESG risks, and so you have to build a framework around your business, both at the parent level and at the captive level.
Great, thanks, Julie. Nicholas, this really perhaps touches again on the social inflation issue and within that probably the emerging risks and risks that have not traditionally formed part of a typical insurable risk, and one where there's not particularly good data or any data at all, yet there is a legitimate case for seeking to provision or for providing some sort of coverage within the captive. As an industry, we're pretty good at quantifying expected losses around historic risk, but where you don't have data, how can a captive owner, captive manager deal with that quantification piece when historic data just doesn't exist?
Okay, so I think in terms of the emerging risks, what happens is that it is always difficult to quantify and also difficult to place into the third-party insurance market. So basically, it may be in the form of some uninsurable risks. So what would help the parent is that if the parent has two choices here, either keep this risk as it is in the parent company or put this risk into the captive. So when it puts this risk into a captive, then it kind of pays a premium to the captive, and this premium what happens is that this premium most of the time would actually be saved up in the captive because these are also events that we don't expect them to happen frequently. So when you save the premium in a captive, the captive is in a low tax environment, then most of the premium will be saved. If you do not put this money into a captive, it will flow through as a profit in the parent, and then it will be taxed. So over time, this low tax mechanism will actually help to build up a provision in the captive, and this provision first it is ring fence and purposeful, because we are actually putting a provision against this risk instead of in the parent company, which may be used for other reasons. And more importantly is that if we cannot really quantify it, at least we try to find as much money as we have, save up as much as possible so that we are able to mitigate this. I mean, the best risk management strategy ultimately is to have enough cash to deal with the problem at a later time. I mean, we can always build scenarios and try to quantify it, but sometimes we are just not able to do this effectively, and we may not want to overly rely on models that may actually not be able to paint a very, very good picture. And when the risk actually emerge, we realize that it's either that we are either not enough or too much, but at least we try to build up the provision.
Thank you.
Can I just say something? Because
Sure.
in the morning, I just realized that you started off calling ESG risk uninsurable risk, but I like the way how Halim has turned the thing around by changing the naming convention to sexy. So when you call it by a different name, sexy risk now, it becomes more exciting for you to pick that up.
Great, and Julie, I think that's a great way for us to round this off. I think the topic of this panel was, can captives play a key role in ESG initiatives? I think from everything that's been heard during the course of the day on this panel, it's not a can, they must play a key role, and whether they like it or not, they probably already are, but that role needs to be an increasingly deliberate, conscious and mindful one, whether it's around the role they'll play in the financing of risk, managing the interplay between the insurance market's ever-changing expectations and appetites for ESG-rated risk, particularly for environmental risk, and also the changing expectations of regulators. So many different elements that ESG is playing into the captive world at the moment. And I think that's a great place to draw this panel to a close. I'd like to thank the panellists. Thanks to all of you for giving us your attention, and look forward to hearing Roy's closing remarks. Thanks, Alma.